Okay, hello everyone. I'm going to tell you something about today that has been really completely muffled out by the mass media. It's been ignored by almost every news agency in the world, and to find out a little bit about this information is so difficult, and yet if you know where to look, it's there to be seen. It's hidden in plain sight. The information is that governments around the world have rewritten the banking rules, and they have effectively allowed now bail-in rules. Bail-ins are being put in place in Australia, New Zealand, the European Union, the United States, and eventually into every developed nation in the world. So for those of you that don't know what a bail-in is, let me just quickly bring you up to date. In 2008, the world's banking system was about to collapse. Virtually all the banks were insolvent, and governments were forced to bail them out with printing unimaginable amounts of new money, and they gave this to the banks to prop them up. The bill for all that printed money, which ran into trillions, went to the taxpayer. That's you and I. And it came in the form of increased taxes and austerity measures almost everywhere, which mainly hit the poor people of the world. Since then, they should have restructured the bank problem, but they never did. Instead, they devised new rules so that in the new coming crisis, yes, and there will be a new coming crisis, the depositors in banks will pay for the bank's errors. They'll pay for them directly by allowing the banks to seize deposits, and those deposits are in fact your savings. So how can they do this? Well, most of you have no clue that when you put your money into a bank, you're actually giving it to the bank. And I mean you're giving it to them because legally and practically you become a creditor of the bank. The money is no longer yours. You have now become an unsecured creditor. And if you don't believe me about that, just check anywhere on the internet about what happens to your money when you put it on deposit or put it into your account at your local bank. So when a bail-in is enacted, the banks can then practically recapitalize themselves using their savers' deposits. And they do this by effectively cancelling your deposit, and in doing so they no longer have that liability on their balance sheet, and this makes them look stronger. It's the same as really a friend giving you $100 for you to look after, and then saying back to them, well, I'm going to keep that, I don't owe it to you, you won't be getting it back. And there's no way that he can enforce that. The money has gone. And that's how a bank bail-in works, and it is entirely legal. And you can see here, the first screen I've got for you is European Union bail-in rules become effective January 1st, 2016. And this was decided back at the Brisbane meeting of the G20 in 2014, when all of the G20, the biggest, largest countries of the world, decided they would all put this into effect. So it's happening all over the world as we speak. In America it's called the FDIC, the Dodd-Frank Act. The FDIC is there as a guarantee, as we'll see later, but the Dodd-Frank Act allows for banks to seize depositors' money. Now it's actually really hard to find anything in the mainstream media to tell you that in January in Europe this is what actually happened. But here's an article from the Telegraph. It's dated the 15th of February, so it's actually very current to where I'm making this recording now. EU calls time on too big to fail with bank bail-in laws. In other words, what they're saying is the banks are too big to fail, so we're going to send the bill to the depositors instead. Taxpayers will no longer foot the bill. Instead, bail-ins will be allowed. And this is one of the few articles you can find on such an amazing piece of legislation. And this is really deliberate. This is deliberate on behalf, it's a collusion if you like, between governments, the EU, the Americas, wherever these laws are going on, and the media, because they don't want to alert people to the fact that their deposits have been put up for grabs. They just want to keep you passive and quiet, and they'd rather have you watching the Kardashians or some other, reality TV show than tell you that your life savings, your pensions, everything that keeps you safe in life are up for grabs by these banking institutions. And just to sort of nail this for you, here is the UK announcement buried on its own .gov.uk site, which virtually nobody visits. And here it is, bail-in powers implementation. the whole introduction, telling you exactly how it works, what the powers are, background on the bail-in, telling you how it works. Everything is there. It's all hidden in plain sight, but on websites that virtually no ordinary member of the public ever visit. But even where the mass media do cover it, they put an incredible spin on it. And here's the Daily Telegraph from London, England. And I'll just show you the kind of spin they put on it. Here in this article it says the EU sues member states over bail-in laws to protect taxpayers. What they're suggesting here is there's some difference between taxpayers and people with savings in banks. So on the one hand they're saying that any country that doesn't implement these new rules will get sued by the EEC or the EU, and also they're suggesting that this is a protection for taxpayers, when in fact we all know that we are one and the same, because there's virtually no non-taxpayers out there, and you and I are the people with our savings in the bank. So this is a spin that the Daily Telegraph have put on this article, rather than warning or alerting us to the problem that this brings to us and our savings. It tries to put an incredible spin that in somehow we're being protected by this, but of course we aren't. Now most countries around the world have some kind of state-run system for protecting the deposits of bank owners, of bank deposits. And you might be forgiven for saying, well, I don't have a problem because I don't have very much money in the bank, and I know that my deposit is protected. And that's true around the world, generally to the level of about 100,000 US dollars or 100,000 euros or 85,000 or 80,000 pounds. So there is some kind of protection out there. But here's what's really interesting I find about this. It says here that the insurance scheme in America, the FDIC, has approximately 25 billion in its deposits insurance fund. 25 billion pounds. Sounds like a lot of money to protect depositors, doesn't it? But let's just have a look at what it's trying to protect, because at the end of Q1 2015 there were in commercial banks currently 10.6 trillion in deposits. So the insurance of 25 billion is really peanuts. It's not even peanuts, it's peanut dust in comparison to the amount of money that we have in the banks. So the same is true across Europe. They have also got similar kind of schemes, but in the event of mass bank failings, there is no money in the system. There is no insurance companies. Any insurance company that was foolish enough to insure a bank against its losses would itself be undermined, as happened in 2008 when one of the largest insurance companies in the world, AIA, went bust the same weekend that Lehman Brothers went bust, because they had foolishly covered many of these banks for the CDs and the mortgage-backed securities that they had, and they realized that they had completely overextended themselves and insured things that they could not possibly cover. So even if you've got savings in the bank, even if you're under the 100,000 or the deposit protection scheme, the chances are that there's nobody there that's going to pay you out. You'll be caught in the headwinds just like everybody else. And if you don't have very much money in the bank, if you're somebody that's living from paycheck to paycheck, then you're even more at risk, because you're the kind of person which can't sustain even a few days or a few weeks without your money. And that brings me to the next really most important part about what happens when a bank fails. Here's a few examples of what happened during the last kind of crisis. This is what happens when there's a financial crisis in a country. This is in Greece. The banks close their doors, and here are people queuing up trying to get money out of their banks through the holes in the wall. And of course eventually those cash machines just dried up and there was no money left, and people were left literally without any help. Bear Stearns closed their doors. Also we have Northern Rock in the UK. We had people queuing down the streets trying to get money out, and eventually the Northern Rock just ran out of cash and couldn't get enough cash. So the truth is that what happens during a banking crisis is that your hole in the wall just won't work eventually. It'll be empty. Your credit card will stop being accepted. Your bills at your bank won't get paid. Your loans won't get paid. Your mortgage won't get paid, and you'll go into default eventually. Even if your mortgage is with the same bank that will not allow you access. And this happened last time. People had money in the bank and they had their mortgage with the same bank, but the bank would not honour its obligation to take each month's mortgage payment out of your account. And so people found themselves with money on deposit or money in their bank accounts, but being told that they were in default of their mortgage. This is what happens. And the other thing is that when the banks reopened, as it did in Cyprus and in Greece, they then immediately put an embargo on how much money you can actually get out of the bank. In Cyprus, people were unable to get more than a few €100. In Greece, the same, no more than a few €100 per week. Banks were restricting businesses from operating. They could not operate on cash. They just shut down the whole economy. And this is what happens during a banking crisis, and it will happen this time round as well. And you may doubt whether or not there will be another crisis, but believe me, there will be, and it's already started, but the news just isn't really filtering through. But once again, we have the Daily Telegraph from London here, just reporting that the chairman of the OECD is one of the most important financial institutions in the world. It actually lays down a lot of financial regulations for most developed countries. And here we have the chairman of the OECD saying that he fears epic debt defaults. And it's just an amazing thing that these articles come out. They are out there if you want to go and see them. The situation is worse than it was in 2007 is the quote here. So it is happening, and it's happening on an increasing scale. And banks are already beginning the process of bail-in. In Italy, there have been already a number of banks that have failed and have bailed in their bondholders, their shareholders and their depositors. And here's a story about Italy bank rescues spark a bail-in debate as anger at Renzi. Renzi is the Prime Minister of Italy. And there's a lot of anger because these banks have already, and there have been 4 so far in Italy, that have bailed in their particular depositors and bondholders. And in one very sad case, a man took his own life and wrote a letter to the bank saying it was them that had killed him. A pensioner in this particular town near Rome hanged himself after his €100,000 investment in the bank was wiped out. And in fact, in this particular story, it was very interesting because what had happened with a lot of these people is that the banks had seen many people who had deposits, sizable deposits in cash in their deposit accounts, and they were contacting these people and saying, why are you leaving the money in your deposit account with no interest when you can move it to a bond in the bank and get 4% interest? And that's very attractive, particularly to people who are on pensions and on fixed interest, and they are not getting anything back on their savings, and suddenly to be offered 4% when they're getting nothing by the very bank that's holding them sounds like a safe and secure and sensible thing to do. And that's what happened to this man. In fact, what happened was the bond failed and the bank failed, and he lost his entire savings and sadly committed suicide as a result. Now you might be thinking that I'm in the US and it doesn't matter to me here if you're a US citizen, but here we have an article on a major gold trading thing which just says if you have money in the US bank, beware, because it talks about the Dodd-Frank Act. The Dodd-Frank Act was the act that was brought in by the US government under Barack Obama. It was a response to the banking crisis of 2008, and it was meant to make sure that these things never happen again. But sewn into these acts are so many often things that you don't know about. And in this particular one, there's an article that tells you that it allows the bank to bail you in. You see, and here it has an article here you can read here. Bank bail-in tells you about how it works. So even in the United States, we have the bail-ins. It's already in place, and the rules will be pretty much the same for US depositors as it is for the rest of the world. And once again here in another part of the world, in Portugal, one of the countries that was badly hit during the 2008 crisis, and they have also started bailing in there. So Portugal's bank bail-in sets a dangerous precedent because one of their banks have failed and they've rejigged things so that people who were invested in that bank have now found themselves with worthless investments to show for it. So you may now be getting the picture that it's already started, because why are these banks getting into trouble? Because if you listen to the mainline news, things are okay. Things are on the up. The US constantly talks about how their economy is growing and how it's strong, and the UK tell people how the economy is strong and how the EU are with their latest 1.2 trillion money printing exercise to try and get Europe up and running, and actually everything is going along swimmingly. This is what the impact of mass media news is at the moment, and yet behind the scenes, as you can see, banks are failing. So let's now look at exactly what's happening today and what alarm bells are ringing for those of us that know the score. So I'm taking you back now to June 2008, and in 2008 nobody would guess that anything was wrong. The world was in the biggest boom in everywhere you could look. Property was booming, the stock market was booming, everything was going absolutely brilliantly. People were making money hand over fist. And here we have this article of June the 3rd, 2008. Lehman Brothers, rumour or reality? Now the writer, Todd Harrison, says we don't do rumours at this particular site, the Minionville, but we'd be remiss if we didn't pass this along to ye faithful, the people who read these off-the-wall little articles. The chat out there, albeit unconfirmed, is that there's a problem with Lehman Brothers, and it's only a rumour, but there's also a problem when the rumour becomes reality. And they also happen to mention that they previously talked about another rumour at Bear Stearns. What's interesting about this article is that, of course, just a few months later, these rumours about Lehman Brothers and Bear Stearns became reality. The rumour said that these companies maybe couldn't meet their liabilities and had a problem with their liquidity. But the truth is, that's exactly what happened. A few months later, Lehman's went broke, and within days, Bear Stearns had also gone broke. So the rumours were out there for those who wanted to listen, but most weren't seeing it because it was these kind of websites, these quiet little blogs that were telling people what was happening. And if you were watching the mainline news on TV or the main newspapers, you weren't seeing any of this. Everything was going along absolutely swimmingly at this time. So you can see here that there were rumours in the market. So let's bring you up to date and tell you what's in the market in terms of rumour today. So here we have, on a website called Zero Hedge, which I subscribe to and get a lot of information from, Tyler Durden's writing an article, is Deutsche Bank the next Lehman Brothers? Now this, strangely enough, is dated also June, but June 2015. And what they're saying is that looking back at the Lehman Brothers collapse of 2008, it was amazing how quickly it all happened. But in hindsight, there were early warning signs, just as I've said. And in fact, they go on to say that it was Goldman Sachs that first alerted the market by placing a massive bet against Lehman Brothers, known as the Big Short. So he's now speculating, is Deutsche Bank going to be the next Lehman Brothers? Well, let's have a look at Deutsche Bank and see what we can learn from that. But just before we do, I want to go back and remind you about Lehman Brothers, because it was the interesting movements in their share price which would have alerted a lot of people. In the months leading up to this, from the sort of that year, the share price of Lehman Brothers plunged by 75%. And then it recovered somewhat, and there were days of volatility where the share price jerked upwards by huge amounts and then jerked back downwards. And this was a kind of an indication that there was an underlying unsettling of Lehman Brothers. Even though in the general public knew nothing about it, traders knew that this was going on. So now I'll bring you up to date with Deutsche Bank. Here we are on February the 15th, 2016, and this is a graph of their share price over the last sort of 3 to 4 months. And you can see that it's been a steady decline. In fact, Deutsche Bank have lost over 50% of its share price. And if I just bring you in on this to a bit of a closer look up of what's happening in the last really few days, you can see these massive movements, drops and rises. In one day, the share price of Deutsche Bank jumped by 10% and then fell back again. And this is once again a repeat of the Lehman Brothers situation, where the market was responding to the rumours that are out there, even though the average person in the street has got no idea what's going on, which is what brought Tyler Durden to the assumption that could Deutsche Bank be the next Lehman Brothers. But of course he was making this prediction in June of last year, where he laid out the case of all the things that were happening to Deutsche Bank at that point. So are we looking at a repeat? Are we looking at a similar situation to what happened in 2008, and the rumours are out there in the market? And will Deutsche Bank be the big event that sets off the next financial crisis? Well, let's see if there's anything else out there that might be affecting us. Well, you know that before an earthquake hits, those people with acute, or those things with acute antennae, know it's coming. Birds fly away from the area in great flocks, and the whole area becomes very quiet. Wild animals run for the hills, and domestic pets that can't get away become very, very agitated. When the sea retreats from the beach, maybe a mile or so out to sea, it's a warning. But this all happens sometimes hours or even days before human beings actually experience the ground shaking, and by that time, of course, it's too late. They say it's happened without warning, but the warning signs are there. We just haven't learned to read them. All the signs are there for people in the financial world to use their antennae to tune into what's happening. But the man in the street, of course, is always caught with his pants down. The informed, the wealthy, never are caught with their pants down. The Cyprus situation happened over a long weekend. The uninitiated went off for a holiday weekend and just came back on the Tuesday to find that their banks didn't open. They found that their holes in the wall quickly ran out of money. They found their credit cards cut off. They couldn't buy petrol. They couldn't buy food. Businesses had to close. The whole thing happened overnight. Now, here's an interesting article from The Guardian. Next stop, New York. Wealthy Russians hurry money from Cyprus to the US. And if we just delve down in here, just find a little article down here. It says, the meltdown of the Cypriot financial system came as no surprise to well-connected and wealthy Russians who bundled some of their money to the United States. Some of these Russians already knew what was going to happen and got their money out, and we know now in hindsight that the London branches of the Cypriot banks stayed open over the weekend, and wealthy people were able to move money or take money out from London, money that had been deposited into the Cypriot banking system. So once again we see that it's the man in the street who gets caught with his pants down, but there are people in the system who know what's going on ahead of times. So I want now to draw your attention to something called the Baltic Dry Index. The Baltic Dry Index is really not known about by almost anybody outside the financial markets. This is an index that charts how much shipping is going on around the world, and as this article says, it's actually asking the question why the Baltic Dry Index is at an all-time low. The Baltic Dry Index is at a complete all-time low. This chart just shows it to 2005, but in fact if you look further back it's never been lower than this, and it's already lower than at the height of the crisis in 2008. What the Baltic Dry Index tells us is that manufacturers are not ordering goods, manufacturers are not shipping goods, retailers are not ordering goods. We also know that commodities are at an all-time low. that means that people are not making anything anymore. They're not ordering commodities, and that's every type of commodity from iron ore to copper to oil. This tells us that the world is on the edge of an economic collapse. If you're not making anything, then people can't buy it. But manufacturers are ahead of the curve. They don't manufacture unless they have orders, and the orders aren't coming because the retailers know there are no buyers out there. And the latest numbers that are coming out of the United States, in spite of the fact they tell us that unemployment has gone down, it has not transferred at all into retail sales, because although unemployment has gone down, the new jobs that have been created are part-time, low-income jobs. So there is no growth in GDP. So the Baltic Dry Index is one of the first and leading indicators that tells us that there is big economic trouble waiting just around the corner. And as I said before, commodities are down, and this is a chart going back 5 years, and it shows the value of and the price of commodities. They have absolutely collapsed by 50%, and in fact it's been going on for longer than that. So this once again tells us that if the price of commodities is down, there's no demand, and there's no demand because there are no people spending money in the world. So now let's focus on the oil chart, because this is one of the most important, and I'm sure you're aware that the oil price has been plunging, and this shows you exactly just how much it's plunging to, and it hasn't yet finished its dive. So why is the oil price important? Because for many people the price of oil should be a good thing. If the price of oil is down, it means that manufacturing is cheaper, it means you can drive to work cheaper, everything is cheaper to produce, and that is a positive effect of the oil price. But there's a very large negative effect when the oil price plunges, particularly when it plunges at this kind of rate, because neither countries that produce oil or companies that dig oil out of the ground can adjust quickly enough with this type of massive plunge in the price of oil. And the price of oil has fallen by 80% in a very short period of time. What this means is that producers of oil are struggling, and out there in the world there are many hundreds of oil producers that will go bust as a result of the oil price, which is now teetering around $25 a barrel. Most of these companies need a price of something between $70 and $100 per barrel in order to make a profit. The shale oil companies, which is the big thing of the last sort of decade, in particular is one of the most expensive ways of getting oil out of the ground. Why is this important? Because what's going to happen shortly is that these companies are going to start to go broke. When they go broke, the debts that they leave behind will be carried by the banks, which brings us right back to where we started, and bank bail-ins. Because the one thing that may undermine the banks is the huge debts that are out there in the oil business. These are massive amounts of money that have been loaned on the assumption that oil would be $100, $150, $200 a barrel, and now it's $25 a barrel. This could be the undoing, this could be the big event that undoes the world's economy. And it's worse than this, because indeed when you look at countries that produce oil, when you look at countries like Venezuela, they've been completely undermined by the collapse, and in fact they now have inflation running at 650% per annum. Russia, Brazil, Saudi Arabia are bleeding money by the billions every single day because they are selling oil at $25 a barrel when they need it to be closer to 100. And they are not cutting back on their production, which is what used to happen in the past, where they preserve their stocks and allow the price to be supported. They are producing more and more, and so the world is awash with oil stock, and the price will continue to fall to the point where some of these countries eventually go broke and default on their loans. This is the financial tsunami that is about to happen, and I can't state it any clearer than that. It might sound like a wild statement, but when you look at this type of thing, when you look at oil prices plunging like this is a disaster about to happen. It always takes a little bit of while for the thing to feed through into the markets. And talking of the markets, we could do a similar chart, of course, on world stock markets. So let's show you what that might look like. Here we have the Shanghai or Chinese stock market. And as you can see, over the last year, it's plunged from over 5,000 to a level of 2,700. So it's had a virtual 50% fall. Now, for those of you who don't understand stock markets tell you 3 to 6 months ahead of what's happening in the real economy. Investors know what's happening and start to mark down the prices of companies because they know profits will not be there, returns will not be there, and therefore the price of the company has to be adjusted downwards to reflect the new coming economics. And this is what this is telling you. It started with the Chinese market when they knew Chinese companies would not be selling as many goods around the world as they had been in the previous years. And here we have the American S&P 500. This is over the same time scale, and you'll see things were sailing along quite nicely until about 6 months ago when the delayed effects started to happen. First we had a bit of a shock and a recovery, and in the last short period of time another collapse in the markets that started at the beginning of this year. And if you looked at any stock market around the world right now, you'd see exactly the same kind of picture. So the stock markets around the world have seen falls of between 60% in some and 70% in some countries to 20 to 25% in major economies. This is all telling you, all these things are telling you that there is a financial problem right around the corner. Now, last time this happened in 2008, China saved the world. But this time it's actually China that's the main reason we're in trouble. They overinflated their economy, they overinflated their production, they spent too much money on infrastructure, there isn't the money to support that, and they have begun the tsunami that's happening. But this time the cavalry are not coming to your aid, and your governments know this, and they have changed the laws and they have prepared themselves to send you the bill directly this time, and not, as they call it, taxpayers, because the last time they were accused of sending the bill to taxpayers. This time they're sending you the bill direct. The truth is this is happening right now, and it's coming very, very soon. If you have money deposited, you need to get it out and have it in cash at home if you have to be. These banks are not paying you any money to hold on to your money, so there's no real reason for you to leave it with them and to risk it. If you only have a little bit of money, then it's even more important that you get that money out of the bank and hold it at home or in a safety deposit box or in a safe, somewhere where you can keep control of it. Because if you lose it, then it's a very big disaster. If a millionaire loses $250,000, it hurts, but it's not fatal. They can live with that. But when you lose all of your life savings, that really does hurt. So what I'm saying to you here is that you've been forewarned. There is a tsunami coming. You need to do yourself a favor and you need to act on it and take action and take control. This is not a fantasy. I've tried to demonstrate to you here that this is a reality. The signs are all there. This is not a conspiracy theory. These are facts. And if you start to use Google and look at websites and look at financial websites, more and more, for everybody from the Financial Times to the New York Times to the London Times are telling us that there are huge problems waiting around the corner. And again, if you dig deep and you'll find some major media are beginning to warn you of this. So here we have the Guardian, the British Guardian from London, 12th of January 2016, so it's very current. Beware the great 2016 financial crisis warns leading city pessimists. Albert Edwards joins the RBS in warning of a new crash, saying the oil price plunge and deflation from emerging markets will overwhelm central banks, tipping the markets and collapsing the Eurozone. So he's talking about a Eurocentric problem, but this will be also a global problem. Developments in the global economy will push the US back into recession, it says here. So this is a major financial market guy talking about the markets. Go to this article here, Just Google that up and you can read the whole article for yourself. My message to you finally before I go is the only person who will look after your money as well as you is you. So take action. Best of luck, everyone.